maybe, Harish, since we have you here, and from the time you have, joined us, it's been about 2 months. And, many of our partners have been really looking forward to, understanding your thoughts and, knowing from you your initial reading and, your insights on how your approach to the overall fund management process, research side has been, and what are the changes that are being driven by you to improve consistency of fund performance here for our equity funds.
Medha, it's indeed a privilege to be interacting with you all today, and facilitated by you, Medha. And I think you put me into the most difficult question right up front, in terms of what is it that we are setting ourselves up to. Friends, as Nida rightly pointed out, it's been about 2 months. I have a calendar clock on a daily basis. It's been about 46 trading days that I have come into the Birla offices. So it's still very early. And of these roughly about 45, 46 days, I think that the first 30 days, if I were to look at it, I was wearing the hat of a consultant, in terms of the fact that, as an outsider, to objectively look at people, processes, team, the coordination, etc. Sometimes, when we are into something so deep, sometimes, many a time, it happens that you end up losing some amount of perspective, and therefore we felt that it was important that before managing any funds, for the first 1 month or so, we will only look at what is it as a reflection as to what we have been doing so far, what the teams have been doing so far, and what are the processes, etc., that need to be improved upon. So, to that effect, basically, maybe I'll just share my screen. Uh, So to that effect, the idea was, when we started looking across, and as an outsider, clearly, when I was in Kotak, we were in awe of Birla from 2012 to 2017, 18. That was a period when clearly, as outsiders then, I would keep saying that, Birla could do nothing wrong. The idea was, what was it different that we were doing then, that over a period of time, due to various reasons, currently maybe we are not doing, or we've lost some perspective on, that can help us in this journey as we're looking to grow our franchise over the course of the next 5, 7 years. And to that effect, while we had a lot of soul searching, etc., I thought that I'll share with you two slides which I thought were at the core of what went right for Team Birla from the period of 2013 to 2017-18. And since then, there have been some patches of great performance, but there have been equal patches of slightly subpar performance. And therefore, if we can try and identify that, as they say, identification of the problem and setting it apart is possibly half the job done. So, with that in mind, when we were doing the soul searching and looking at quant and data of how portfolios were constructed, we came across this exercise. Okay, so as you know, all of you business partners clearly understand the Pareto principle, the power law, etc. 80-20 principle, right? 80% of clients or 20% of clients get you 80% of business, and that principle holds true pretty much in every aspect of life, right? Now, for a typical AMC, and we have data. Broadly, about 75 positions, which we call the core, account for 80% of total AUM at various points of time, right? And therefore, the core pretty much determines whether the AMC AUM does better or has shades of problem, etc. Right now, to this core of top 75 positions, we basically broke down into three parts, right? The first part, we said that if it if any of these top 75 positions were part of the top 15 positions of Nifty, and as especially given the passive wave, etc., given the importance of benchmarking, which has happened in over the course of the last decade or so, those are primarily tracking positions that any AMC will have, right? Just a case in point, it could be names like Reliance, or an Infosys or an HDFC Bank, etc. And while we do have views on a lot of those businesses, by and large, their positions are primarily also designed from a tracking point of view compared to the biggest benchmark, which is that of Nifty. The second bucket that we broke down was into the remaining positions of Nifty. So clearly over there we have some amount of active overlay over there, but that still is, because it's part of Nifty. Many mandates tend to kind of replicate some aspect of that exposure over there. And the third part, this is the real core of any AMC, is that this is the true differentiator, which is part of the top 75 positions of an AMC, but it is not part of the Nifty, right? And this pretty much sets one AMC apart from the other. So when we looked at how the data looks like, and this is how, and I know it's a cluttered slide, etc., but we just wanted to get you some sense of the data that we are looking at, so as to kind of objectively look at this point, right? So this is basically on a quarterly basis. What we have put is our top 75 positions, and of course we have got beyond 75 also. So if I were to look at it, the first column is Nifty top 15, the next column is Nifty next 35, and these two put together is what is there in Nifty 50, and the third or this column is basically that core alpha, right? Now if you look at what used to happen in say 2013, 14, 15, 16, 17, just have a look at this slide, right? Here, maybe I'll just highlight it. This was a phase wherein, as much as 43, 49, 45, 39, 40, 47, etc. percentage of the fund house was present in. And currently that number stands at about 21%. Right, this is as of end of September 23. So over a period of time, what is the core true differentiated portfolios, due to various reasons, multiple people, multiple mandates, etc., has come down quite dramatically. And if you were to, so we did also this work on other AMCs, and while we are not sharing the data here, by and large, if you look at it, most other AMCs typically operate between 30 to 45, 50% in this bucket of core 75, right? This is the third bucket. So currently, clearly, while over a period of time when we are doing very well, it used to be very large portion of our AUM. Over a period of time, it started to come down. So this is the first key observation that we're presenting. The second thing is, of course, that while this is talking about allocation, the more important thing is how much alpha is this allocation giving up, right? And which is this slide, right? So if you look at this column, which is non-Nifty till 75, okay, this is the 1 year forward alpha of holding in this. So just look at the alpha that used to come through in this period, right? From September 13 or June 13 onwards till June 17 or December 16 or May 17. We have had about 16, 17 quarters where alpha used to be as high as 28%, 30%, 15%, 12%, etc. And from 2017, 2018 onwards, in fact, over the period of the last 16, 17 quarters, this core hasn't fired, right? It has kept giving us pain. The good thing is, as you can see, this pain has started reducing. So what used to be 15% due to a series of interventions in processes, etc., this alpha score has started reducing, and which has clearly also started to see through in terms of overall performance. More importantly, if you look at our satellite positions, they are still giving very good alpha. So two positives that we can see through clearly in this slide, if you ask me. One is that A, our share of negative alpha has started reducing. B, what we have in the satellite, the tail, is actually doing quite well. So it isn't that, we are terrible stock pickers all throughout. So what is in the satellite or in the tail needs to come more and more into the core, and we need to get our overall effectiveness of the core. And so that broadly is the key message or the key direction towards fixing the core that we are setting out. So while there are close to about 7 8 programs that we are running internally to improve processes and efficiencies and monitoring, etc., the sum and substance of what we identify is that when we were firing so brilliantly, it was because our core was firing so very well, which over a period of time has got diluted. Our allocation into core itself has reduced from whatever 40, 45, 49% to currently about 20%. And the extent of getting the alpha from this core has also kind of come off, which is the exercise that we are trying to reverse. As I said already, the progress is started to come through, both in terms of the extent of the negative alpha as well as the satellite positions getting their act right, is very heartening, right? So therefore, among the many things that we are working on internally, to an external observer like yourself, I would think that broad attributes that you will see us work meaningfully towards is that we are going to see a consolidation of our holdings. A lot of our tail positions will get reduced. Thankfully, markets have been very kind. We've seen a very good rally in the across the length and breadth of Indian equities, and therefore we're using this as an opportunity more than any to reduce our tail. So we're going to start consolidation across holdings. Clearly, as I identified, the key is to get this core alphabet holdings. While it's impossible to say that 20% will become 45%, etc., but directionally, we definitely do think that with every passing quarter, every passing 6 months, we are starting to move from 21%, 20% to say 23, 25, 27, 30, and onwards as we get greater confidence in terms of our calls getting more and more right and getting replicated across funds. So that's the second key aspect. The third key aspect is we are augmenting our research strength. There have been hires on both quant as well as other resources that will get further added. We have a large team, but we are going to further add to our research strength to show our commitment to this business and to get our quality of research significantly better, so that the outcomes start meaningfully improving. So that's the third aspect that we are driving towards in terms of our deliverance. The fourth aspect is, essentially we are in the business of assessing risk and to arrive at returns, right? So what actually qualifies as a core holding is basically that it has to have an asymmetric payoff. What does that mean, asymmetric payoff? So if you look at say an x-axis and x-axis of risk and y-axis of returns, ideally you want positions which have low risk, medium returns, medium risk, high returns, or high risk and high returns, right? Any other combination actually is inferior than these three buckets. What we are conscious about is that in our core, we want to have more of low risk, medium return, and medium risk, high returns. We want to keep the high risk, high returns into our satellite positions. And as and when their risk comes down, that is when we want to add back into the core. The other aspect of, when we look at our processes and how we are looking at evaluating companies, is basically we are saying that this core top 75 or top 100 companies typically are going to be looked at from an absolute return point of view. So the way we look about companies is that how soon can these companies double? What should the companies do to double their enterprise value over the course of the next 3 years, 4 years, 5 years, 6 years? Typically, smaller companies, we are looking at between 3 to 4 years, a doubling of their overall enterprise value. And for the larger companies, maybe 5, 6, maybe in certain cases, even 7 years. So the idea is to look at it more from an absolute return, to have a conviction that many of these positions can work out. Of course, we all know that it is probability, there will be some positions that don't work for us, and therefore we need to have a risk mitigation plan. But as long as we have got more calls that are getting meeting their objectives with lesser calls giving us pain, I think we can provide significant value add to our clients. And most importantly, it's our belief that the difference between a good fund manager and a great fund manager is not so much as to what they buy. The buying discipline for most fund houses and for most fund managers typically is always good. It's the selling discipline that separates the good from a great fund manager. And to that effect, we are going to significantly deploy quant frameworks to help us improve that. So, I'll kind of stop there. I think I took a bit too much time to kind of explain to you some of my learnings. I mean, while these are all some directional changes that we are working on, the reality is ultimately, it is people, processes, and technology that make for strong execution in a fund house. Very excited with the talent pool out here in Birla. A great blend of both experienced as well as yeah, people with significant drive to prove a fire in the belly. And I think it's a brilliant kind of a combination that we have. Like I said, we have a very large team. We want to further augment our resources in terms of research. We want to get differentiated research in the form of quant, forensic, etc., to add to our capabilities. And therefore, with the direction that we are setting out towards, we do expect to see meaningful changes in the portfolios. As an observer, I think you are going to see changes into multiple aspects and multiple dimensions of our portfolios. It's not to say that currently what we are running is bad, but can it be more sharper? Can it be more agile? Can it have greater selling discipline? These are all the vectors that we are measuring individually, so that the outcome is far more sustainable, and valuable to all our unit holders and to our distribution partners. I'll kind of stop here, Medha, and for you to shoot the next set of questions.
Sure. Thank you, Harish, for taking us through with such in such detail your insights, and instilling so much confidence on the changes in our some of the changes, course corrections, and the outputs, the clear outputs and goals that we as a team, investment team, is targeting. So thanks a lot for that. Now let's move to the next segment, and the point of discussion that we have decided for us today, which is business cycle fund. So let me try and sort of have your insights on your thoughts around business cycle investing, and how do you identify business cycles, economic cycles, and accordingly, maybe your initial thoughts on how do you position your portfolio.
I think this is a great segue into the discussion for the evening. Of course, we spent a reasonable amount of time explaining the broader direction of the asset management entity as far as equities is concerned. Now, see, business cycle framework, I'm a big believer of man plus machine is going to be far greater than man or machine. And I think, as Medha, you started out saying that, while I have great experience or reasonable experience on the fundamental side, one thing I pride myself about is also on the objective quant, research that we've kind of done over a period of time. And I think business cycle framework is possibly the best blend of my strengths, so to speak, of both top-down macro level understanding as well as blending in the benefits of quant. So now, what is business cycle? I mean, I think it's important to understand from a first principle that business cycle is actually any investing is in some sense a business cycle investing, right? Basically, all sectors and businesses go through cycles. Some cycles are shallower, some cycles take much longer. But there is no business, there is no sector which is not cyclical, right? Now, if you really look at the reasons why businesses or sectors go cyclical, I mean there are two broad vectors, right? You've got the supply side and you've got the demand side. Now, in India, I'm sure all of us have read through and seen enough research about India being at a J curve, per capita income going from X to Y, per capita income of India is this. China, when it was this was the demand, etc. And I think we can all reasonably agree that in India, there is no real sector which doesn't have a runway of growth. Every sector in India has reasonable penetration stories, so to speak, which can continue to keep going through, right? So to have a thesis basis demand, possibly, is like a non-event in my opinion from a cycle understanding point of view. Of course, the demand itself can see a change due to, say, habit change. For example, while we may all agree that car penetration is low and we can see significant amount of traction, but whether the car penetration is likely to move from the traditional ICE to EV, can we see a greater premiumization, etc.? All of those are points to ponder about from a demand point of view. But to me, the bigger source of cyclicality in cycles typically comes from the supply side. And supply side is basically reasonably simple and commonsensical, which is that when some companies make supernormal profits, it attracts competition. That leads to larger number of players coming into that sector, putting in more capacities, etc. And as they say, success sows the seeds of failure. Similarly, companies become complacent, and then you start seeing the sector downfall. Similarly, on the other side, when the most inefficient player, especially in a very cyclical sector, if the most inefficient player makes truckloads of money, that is typically the time where one needs to have caution over that cycle, or over that sector, and possibly take a contrarian stand, right? So now, while these are on the ground aspects of business cycles of sectors, in the marketplace, which is the stock markets, these business cycle gets further amplified by the extent of positioning or ownership of these stocks, which is that many people think that a cyclical sector is a structural sector, or they think in a structural sector, as they see a cyclical slowdown, they start attributing it to be a significant slowdown, and therefore start extrapolating, and therefore the positioning becomes lower, and this further amplifies the opportunity that one can have to play that thing. So, in some sense, the thesis of any business cycle fund, to my mind, is basically an interplay of assessing where the business cycle is and how the markets are positioned in lieu of that business cycle, and therefore to spot opportunities. Now, be it in the form of fundamentals, be it in the form of quant, be it in the form of behavioral, be it in the form of technical, if you were to really think about it, any signal, there are only two signals that any practitioner looks at. Okay, even when we are looking at annual reports or when we are looking at screens, these are the only two factors. The first signal that one is looking at is reversion, which is mean reversion, right? Which is that if something good has happened, it, will it reverse? At what point will it reverse? So you're constantly keeping on thinking that when is it that it's going to reverse. Similarly, the other signal that we are focusing on is on the trend or momentum, which is that can what is working continue to work for much longer. Now, obviously, you can't mix both these signals, right? What I have found over a period of time is lower down the curve, which is if you're talking about a particular person. No, so for example, if I were to take a US example, Jeff Bezos, and if one were to say that, the average time frame for a super normal CEO is say 10 years, chances are that you will always find super normal CEOs which will defy that odds. And therefore, you cannot have a program which says that after 10 years, you need to cut weights and you have to sell that stock, etc. You will always going to keep getting surprised when it is lower down the curve, which is either a business leader or a business unit or that of a stock, right? But as you go higher and higher, which is that of a sector or a market cap or a country, the moment the reversion factor starts taking a bigger and bigger call. So therefore, it is important to identify when you want to blend both of these two things to further help in understanding the business cycle. Now, what is therefore a business cycle, and is it any different from a flexi cap construct, right? So, in some sense, they are very similar. So, if you were to look at flexi cap fund, most flexi cap funds have a universe of about 500 stocks. A business cycle can also go anywhere. So, broadly, the universes are very similar. But the differences start coming through when you start looking at actual funds and how business cycle can therefore be slightly more different from a flexi cap fund. So if you look at sectorally, okay, most of the flexi cap funds will typically tend to be benchmark aware. Most of them, of course, there can be exceptions, which is that if, say, for example, banking is 30%, we'll be at, say, 25% or 22%. On the negative side, and on the positive side, maybe we are at 35 or 37. Typically, various risk management girdles come through on a sector point of view. Whereas in a business cycle, because not all businesses will be at the right time at the right place from a business cycle point of view. Generally, the sectoral skews will tend to be very, very large, which means that you will find sectors where you can even have a 20% active underweight or overweight if you are confident of your thesis of the investment cycle, right? And that is where the big active calls start coming through, right? Which also means that you will have, say, three or four large sectors which account for bulk of the allocation. Unlike a typical flexi cap, and of course, today in today's construct of markets where financials account for, say, 30-35% of market, it appears that the top three or top five sectors are equally chunky in a flexi cap fund. But by construct, I would say that the business cycle will have a far higher sectoral skew, will be less diversified when it comes to sectors. From a stock point of view, we generally see that flexi cap funds typically tend to have between 60 to 80 stocks. Our endeavor would be more closer to 40 to 60 stocks, wherein we do think that there is reasonable diversification benefits to be gained. From a market cap skew, especially in today's construct of where various flexi cap funds have been, larger companies, typically the top 100 companies, if you look at most of the flexi cap and if you look at the average flexi cap fund, it would be close to about 70% or about, right? Whereas in business cycle, it can actually be truly market cap agnostic. We do think that, the share of mid cap and small cap can tend to be much, much higher than a traditional flexi cap fund, which all boils down to this one variable called the active share. Active share for partners, I'm sure most of you know about it. It's basically how different is the portfolio compared to the benchmark, right? So from a flexi cap fund, typically good flexi cap funds tend to have an active share of between 50 to 65%. In the business cycle fund that we propose to manage, which I propose to manage, I think that the active share will be even higher. It'll be between 60 to 80%. Which brings to the question that, portfolio turnover typically in a flexi cap is a lot more stabler portfolios. Whereas in a business cycle, because the cycles tend to be a lot more faster, you will tend to see a far higher portfolio turnover. So the sum substance of it is, I think that a business cycle fund is actually a flexi cap fund with far more active calls, a far greater portfolio trading intensity, a far greater large mid cap, small cap mix, a far greater sectoral skew, and therefore it puts the conviction of the fund manager on the line to kind of demonstrate, and which is why we think that business cycle is a flexi cap with a big difference, which can be exploited in a meaningful way by partners allocating into this category. Yeah, so maybe I'll kind of stop there, and then maybe I'll go into the next question, possibly Meta.
Yeah, thanks, Harish. I really like the way in the great detail that you have, compared business cycle and FlexiCap fund. And actually, that's a very, very important area, I believe, when we are explaining business cycle. And especially from your standpoint, because you're the fund manager for both the schemes for us. So, how is your approach different in one to the other? Now, an important point that you touched upon in the previous slide was mean reversion, and how cycles are dynamic, and how trends are more mean reverting in their nature overall. From that standpoint, when we talk about business cycle, and as I understand it, cycles change, but what is important from the standpoint of investing is identifying the change of cycle way ahead than the change when it actually happens, and positioning the portfolio and the sectoral positioning accordingly in the fund. So here, and maybe if you could elaborate a bit more on what your approach will be in terms of, and especially in a world of like n number of mixed signals being posed upon any portfolio manager.
So yeah, this is the toughest part, right? Because while all of us can have frameworks and we can all say कि बस अभी healthcare चलेगा, अभी इसका time है, अभी IT का time है, etc. At the end of the day, do you rely on intuition? And I'm not saying intuition in the sense that there is no data that goes behind it. Obviously, there is data that goes behind each investment professional's decision. But can we be more objective? Is what will help us get that clarity, because here the active calls are so big that you need to be therefore even more convinced of taking those active calls, because the chances of error, and we will all make mistakes. I'm sure that whatever system that we put in place, there will be mistakes. But can we try and limit those? And so it is in that framework that we want to blend in the best of top down, macro, and quant together to help us arrive at better decision making over a rolling 3-year kind of a time frame. So the approach that we have at Birla Business Cycle Fund is basically a three-pronged business cycle framework, right? And I'll possibly give you a few examples, maybe to kind of further illustrate some of these points across sectors, and maybe we can even do it on Q&A. But broadly, if you were to look at it, we've broken down into three separate signals to help us arrive at a consolidated view. And of course, after that, there still is a human judgment to assess where each of the signal is, and then to arrive at it, right? So the first framework that we use is called the sector cycle. Where is the sector in a cycle? Now, for that, what we look at is the profit pool share and the market cap share. Okay. Very broadly speaking, we look at the top 1,000 companies' profits, and we try and look at how the various profit pool shares have moved. And there are various kinds of sectors, and I'll explain to you in a few examples in some time. So we look at how the profit pool shares have trended and how the market cap share of that particular sector has trended over time. As I said, this is a good reversion signal, but it gives, more importantly, a good framework to look at where on the ground objectively various sectors are positioned from a profit pool and a market cap share. Okay, so while I said a business cycle is an interplay of sector cycle or as well as the market cycle, so coming to the market cycle aspect, now over here what we look at is we look at the ownership share. We look at ownership of institutional owners, which is basically the mutual fund and the foreign institutional ownership, as well as we look at the valuation feedback loops. So for, and I'm just giving an example. So if you've got, say, a PSU company throwing a 5,000 crore profit, and let's say a fintech company throwing a 5,000 crore profit, the market may value that 5,000 crore very differently, coming from a PSU from an energy sector to a PSU coming to a fintech company throwing that 5,000 crore, right? And therefore, there is always going to be a disconnect between the market cap share and the profit pool share. But how disconnected are they is what gives us that feedback of whether valuations have gone extreme or whether there is still some more room for valuation to kind of seep through, right? So that is the second aspect. And the third aspect, once we have identified the sectoral cycle and the market cycle, is basically to look at our quant framework, which is basically looking at within a sector. Okay, is it the micro caps that are doing extremely well, even as the large caps are struggling, which means it is more likely to be in a distribution phase wherein people have first made money in large caps and they have kept going down the curve to make more and more money down, which means that possibly, one should be a bit more cautious, or whether it is the larger and the best of breed companies which are starting to perform, which means that possibly the cycle still has lot more room to go through, and to look at factor screens, primarily the momentum factor and the quality factor, and the what we call the fundamental earnings factor. These three factors blended together, we arrive at stocks bottom up within these particular sectors to kind of identify. Then, of course, as we all know, this is a this still is going to while it is as objective as possible, there still can be mistakes. There still can be room for time frame to get delayed. There is no precision out here. Most of these calls will take anywhere between 6 months to 18 months to play out, and therefore we diversify prudently across multiple stocks, 40 to 60 stocks, so that at some point or the other, some of the other sectors or stocks start playing out. So you know so this is broadly the approach, which is basically profit pool share, market cap share for sector cycles, ownership share and past returns, and the size factor, as I told you, whether it is the smaller companies and the micro companies which are doing well in a particular sector, or are the larger companies doing well. That gives us a sense of the market cycle. And then we look at the quant screeners across those three factors to arrive at bottom up stock identification. So this is broadly the approach. Now, let me start out with the profit pool concept itself. While we may not have time to explain each of these sectors or each of these key variables, maybe I'll explain to you some sectors and some profit pool shares to give you some sense, right? So broadly, if you were to plot the profit pool shares of the top 1,000 profitable companies in India over the course of the last 25 years, you generally see three trends of sectors coming through. The first set of sectors are basically compounders. These are companies, which typically over a period of time, their profit pool share as a percentage of total profits tend to keep going up. Right. So examples out here could be the FMCG sector, the pharma sector, the IT sector, private banks, where over a period of time, again, I'm talking about 20, 25 years. We are not talking about, 1 month, 3 months, 6 months. We are talking of long periods of time. They have generally exhibited greater compounding and greater increase in their profit pool share, right? So ideally, you want to be over indexed to these kind of compounders, because in under 5-10 years, they'll become even larger as a percentage of total profit pools, which is one approach, right? The second set of sectors are the eroders, and maybe destroyers is a too harsh a word, but these are sectors where the profit pool share has reduced with time. And it's never a straight line, neither is this a straight line. There are always cycles even within that straight line. Similarly, even for the eroders or the destroyers, there are always cycles which go down, right? And there are multiple sectors which have happened over a 25-year period. Of course, at different points of time, different parts of these sectors will start appealing that, there can be a resurgence. And of course, there is an assessment of that we need to see through, right? But the more important thing are the pure cyclicals. These are the sectors whose profit pools typically yo-yo with time, right? And many Indian sectors are present here: auto, cement, metal, consumer discretionary, industrials, media, etc. These are all sectors which typically yo-yo with time, and therefore you do get significant trends out of each of these. This is, in some sense, the total profit pool, of Indian companies. This dark shaded line, currently close to about 13 lakh crores. So if you look from 2001 till 2023 September is where it's plotted. And this line is the market cap of total Indian of these top 1,000 companies. Broadly, if you can think about it, they tend to move in tandem, and this is broadly what we are also trying to refer to, that we want to be over indexed to companies and to sectors which typically tend to be compounding. We see great opportunities in cyclicals. We do see some opportunities in those which typically tend to come down with time, right? So yeah, this is the profit pool share. Similarly, we plot the market cap share across time. We plot the ownership share across time. We plot how within a particular sector, for example, I'm just giving a case in point, in say the steel sector, is it the larger companies and the more efficient companies that are gaining market cap, or is it the more inefficient companies, the smaller companies, that are gaining ahead? And both have completely two different dynamics. So all of these things then get fed into that quant framework, wherein we look then bottom up to arrive at the final portfolio. In obviously an assessment is there from me as the fund manager. So maybe I'll kind of stop here in the paucity of time, and then we can move on to the next question.
So yes, so Harish, of course, we spoke about the process, the philosophy for the fund, and now, the actual thing. And what I want to know from you is, where do you see the cycle at this point in time? And which are the sectors that, you are currently focused on from the fund's perspective?
Right. Yeah, so clearly there are the larger sectors of banking and IT. Then there are opportunities in healthcare. So maybe to give a flavor, why don't we take the participants through some of the sectors? I know there are a lot of sectors, but maybe we'll just give a sense as to what is it that we look for, so that they also get an appreciation of how the portfolio is likely to get built up over time. Right. So let me start out with the profit pool share of the private banks. Right. Now, if you really look at the private banking setup, the profit pool share, like I said, it's a compounder sector. It's at an all-time high in terms of the profit pool share, close to about, I think, if I'm not wrong, about 11-12% of total profits is coming from the private banking side, compared to the 10-year average of about 8.5. So clearly, while it typically tends to move much higher, it's potentially kind of in a very good zone, wherein we all know the headlines. The NPA levels are at the lowest, the credit growth is starting to fire up, and you've got the NIM expansion coming through. So you've got the best of all three worlds coming through, right? If I were to look at the market cap share, so if you really look at it from 2019, or maybe pre-COVID, is where it kind of peaked, and from there the market cap share has kind of stagnated, and in some sense, it's also led by a few large heavyweights going through a slightly bad patch of appreciation by the markets. But you clearly are going through a zone wherein the market cap share has kind of come through, which brings this delta, right? Market cap share less profit pool share. So if you really look at it, this was broadly in this region of about 1 to 2% higher market cap share compared to the profit pool share, which means that if the market is trading at say 16p, these banks used to trade at say 18 or 19p, typically at a premium, which is why you typically see a greater thing, right? Today, we are seeing a complete reversal wherein the profit pool share is significantly higher than the the market cap share. But it's also important to realize this phase from 2017 end, possibly post the demonetization, wherein you saw that huge polarization happening, right? So what was a 2% band went overextended itself to close to about 5% overweight. And in some sense, we've just started letting off some of those excesses in some sense. So that's the assessment that I have, that currently the banking sector is in very good shape, but the overall profits are at a record high. As a percentage of GDP, they are at 1% of profits, which is the highest it has been in the last 25 years. Like I said, this is a time frame where everything is going right, and which means that potentially things can start weakening. Uh, The other hot topic clearly is that of PSU banks. Looking at the same framework, clearly they've moved up significantly, but they have now reached levels which have been the levels that they used to be, pre that huge NPA scare from 2013-14 onwards. Which means that really one has to take a fresh look at PSU banks, whether they can create meaningful value accretion over the course of the next decade or so. So this much was a mean reversion trade of profit pools coming back. Can Is there more steam left? Again, in terms of market cap share, they have gone back to their previous levels pre-COVID, or pre that entire NPA thing. So the big part of that re-rating, from absolute very cheap to very cheap levels they have come through. Is there more steam? Market clearly, especially in the last 6-9 months, seems to highlight that. But specifically to the banking sector, if you were to look at, this is a phase, for example, in the last 9 months, the headline or the frontline banks, which have all reported great numbers, haven't really performed, whereas money has kept going down the curve, right? And you've seen performance in the, so when we say that the size factor, micro cap over large cap, we've seen one of the biggest moves that have happened, which typically doesn't augur well for this kind of a space, in my view. Similarly, if you've got, say, if you look at the IT sector in 2021, you had the similar kind of a thing wherein the larger caps, which led the rally from COVID lows till March of 2021, they were performing, and then from March 21, they started, kind of, derating, even as the micro caps within that sector did very well. And then we all know what happened in 2022. So while I'm not saying that this is what is likely to happen, but I would be slightly more circumspect out here. Which brings me to this sector, which is IT, which I think can be a great sector in a compounder segment. So if you look at IT, right, around the dot-com level, it used to be 5% of overall profit pool. Close to GFC out here, it reached about 8% of profit pools. Then it reached to about 12%, and then during COVID, it went to as high as about 13-14%. And today it is back to about 9% of profit. So this, the entire last decade, it has come back to that kind of a level. The question really is, can this 8-9% go back to 11-12%, or is it likely to go to 8-9%, or is it likely to come down further? I suspect that in a 3-year time frame, of course, there is a recession in the horizon in the near term. We are likely to see this starting to move up. So there is an opportunity in IT. If I look at the market cap share, less profit pool share, unfortunately, they haven't reached the cheapness like we saw in 2017-18 or during COVID, wherein it gave a tremendous opportunity. They're still slightly more expensive out here. But if they correct, I think this is a great opportunity for the sector. Under such opportunity, if I were to quickly move on to healthcare, because this is another space which I think can be a complete dark horse. This is a space, if you were to look at it, current profit pools have gone, it's oscillated between 3 to 6% broadly, 3 to 5.5. We are now at a 15-year low in terms of profit pool share. In a sector in the last 5 years where overall, NSE Pharma has given a 2% or a 3% CAGR, in a space where promoters have got, say, 60 to 75%. ownership in a space where borrowing levels have come down and cash flows have come out strongly. I would think that there is a reasonable opportunity in the business cycle and the market cycle of healthcare. So yeah, there are multiple other sectors. Utilities is another one where I think there is an opportunity where clearly market still is a bit underappreciated. So I mean, we can keep going on. Auto is another sector where I think there is still an opportunity. If you look at from about 2.5% to 9%, we are close to about 4.5% of total profit pool. Possibly, we still have some more. So when we say 4.5%, going to say 5.5, 6%, it effectively means that they will tend to grow faster than the market over the course of the next 2, 3 years in terms of earnings, and therefore that is the opportunity in terms of. So again, market cap share is significantly lower from their all-time highs. So there are opportunities even as markets overall, are giving far lesser opportunities, but we do see opportunities, like I said, in healthcare, in auto angs, capital goods is another area where we see that opportunity. Utilities is another area where we can see an opportunity, and so on and so forth. So I think we'll kind of stop here to take on any further questions.
Yeah, so thank you, Harish. And though, we can keep going on, and I have a couple of more questions lined up, but in view of paucity of time, maybe I would start with taking some of the participant questions that have come in our Q&A section. Just give me a moment. Yeah. So the first question that I have is, what's the current ratio of market cap versus profitable earnings, and what is the historical average?
Right. So currently, if you were to look at market cap vis-a-vis profitable earnings, it's close to about 21, 22 times. In fact, it's the larger caps is actually lower. Small caps and micro caps have actually gone up significantly higher. This is all obviously on a trailing basis. So clearly, from a historical average point of view, we are at the 90 percentile. What does that mean? If I were to plot all the P's of market cap vis-a-vis profitable earnings, there are still 10. So if there are totally, say, 7,500 trading days in the last 15 years, there are about 750 odd trading days, which is roughly about 3 years cumulatively over that 15-year stretch, where the PE or profitable earnings or market cap over profitable earnings were even higher than where they are currently. So roughly it is in the 90 percentile range.
Sure. So Mr. Shumi Thomas wants some updates on the market from you. Maybe, we actually didn't cover that broader market. Maybe some quick insights on that.
Right. So this is the typical question ki market kya lagta hai. So clearly we've had a lot of positives in the fact of earnings have been reasonably strong. Flows ki abhi sab umeed kar rahe hai ki FII flows will also start coming through, especially after the state elections come through. By and large, I think that we have kind of in the short term we have possibly gone up a bit too soon, too fast. While we shouldn't be banking only on flows to come and pull up markets. I think earnings also need to deliver. The last 3 quarters, if you were to look at earnings, they have kind of been flat, X of banking and X of energy. So therefore, we while overall they're still good and compared to the rest of the world, things are still much better. But given the quick gains that we have made, I think the next year should be a year of consolidation rather than believing that we can sustain these gains. Within that, clearly we do think that B2B businesses are in much better wicket compared to the B2C. Consumer थोड़ा slowdown दिखा रहा है. The investment side continues to do really well. Real estate continues to do really well. Capital goods and all of that pack, I think, can continue to do quite well. So yes, there are opportunities, but overall market, मेरे ख्याल से, it's going to be more consolidation mode, time correction mode than anything else. Is my best guess.
Sure. So an interesting question from Mr. Amit Trivedi. Business cycle fund will have a big sector theme investing, or it will be business cycle turnaround for a company? And I think that's an
Yeah,
important
it's a
question.
brilliant question. So by and large, we'll be looking at a sector turning around and a sector getting their act right with very low positioning by the market, right? And therefore, when you get both of that going through, you'll get that. Typically, in very low points of time, you want to be in the best run companies. And as the cycle starts going through, is when you want to look at the turnaround cases. So while we are not really saying that we'll not be looking at turnarounds, etc., but at the absolute low point of a business we don't want to really play the turnaround, because I mean बोलने की बात है कि 3-6 महीने में cycle turnaround हो सकता है, but it can last maybe 9 months, 12 months, or even 18 months. And therefore we want to be clear that we don't want to be too reckless with taking on risk at that point of time. We would wait for the cycle to turn around, the sector to start doing well. Initially, when a cycle starts doing well, it's generally the larger companies that do well first. And then, we want to be agile enough to look at these turnaround opportunities. But in short, the bigger story would that be of sectoral turnarounds from a business cycle point of view, not necessarily a turnaround of a company alone, though we would love to play both, but by and large, it'll be the first.
Sure. So I have a couple of questions, and especially this one from Mr. Amit Gupta, though you've touched upon it during your narrative. What would be the number of sectors normally that this fund would have, and the top 3 sectors that you would be betting on initially?
So it keeps changing. Like I said, this is a space which will see a faster turnaround. It's been only about 15 days since I've started managing this fund. It's too early to really letting it out like this, but I would say that the top 3-4 sectors should be about 50-60% of the total fund, right? So in case the sector is good, it could be a very small sector in the overall index maybe, but we could own even 20-25% in a particular fund, especially as the sector gains greater traction. To start out with, maybe we'll have say 6-7%, but as the sector gains traction, we won't hesitate to go to even 20-25%, even as say the index weight might be only say 3-4%, which is why that great sector skew that I said can come through. Right. So I would say that the top 3 should broadly account for 50-60%. Of course, I mean, it's all subjective, what is a sector, etc. In the sense ki kya classification broadly, but yeah, the idea is to be punchy with the sector allocation.
Sure. Any suggestions, Harish, around the time frame for investing in this fund, as in what is the time horizon that an investor should ideally target? The mode of investing, lump sum versus SIP, and I do also have a couple of questions whether it's a good time to put some lump sum money in this fund.
Quite honestly speaking, from a market perspective, one will always say that markets being where they are, one will definitely prefer a staggered investment over, especially when you've got such a strong 6-9 months to suggest that, right? So I would still say come in a staggered fashion, but here I would say that one should at least be looking at a 3-year horizon bare minimum for any equity product. In fact, for I would say at the current valuations, it should be a 5-year horizon. But I would say that in within 3 years, all our back test, whatever we've done, seems to suggest that there is a reasonable chance that most sectors will start playing up. Like I said, you want to be slightly ahead of positioning into a sector, and then to increase that scale. Sometimes some sectors start performing 6-9 months for itself. Some sectors can may take 12-18 months or 24 months to perform, and so you need to have a mix of both of them. And therefore, you ideally want a 3-5 year kind of a horizon, so that at least some of those calls play out, and therefore you start reaping the benefit of that allocation that you have done, say now or over the course of the next 6 months.
Sure. I think in this way, Harish, you broadly even touched upon the caveats that I was going to ask you about while an investor, considers this fund. I think time horizon, giving time to this fund is one of the biggest thing, right, around investing. Another question that I have from Akib Sheikh. What's your view on the rally in the small and mid-cap space? Do you feel there is enough room for growth or valuations are stretched there?
So I think near term definitely valuations are stretched. Okay, I don't think that we can because it's the same story cannot keep we cannot keep extending and stretching the valuations, right? So while we all know what the positives are, stronger growth, the fact of a strong political establishment, etc., we definitely see greater value in larger mid companies, I would put it, than into the small and dare I say even micro cap companies. Of course, if you genuinely have a long term horizon, can you make money in small and mid caps or micro caps? Absolutely, yes. But ये time की बात है कि everybody thinks that they have genuinely long term money, but experiences in the near term can shake them off. So from allocation point of view, I would be a lot more confident on larger and larger mid cap companies, the top 200, top 250 companies at this point of time, than on the bottom half of the market.
Sure. So, in order, in the view of the time that we are at, I think it's time to pause the session. While we thoroughly enjoyed, having you here on this platform, Harish, and thank you so much for so liberally sharing your thoughts, insights with so much detail and data. And thank you so much to all the viewers for being on this session. And I'm sure we'll invite Harish for many more sessions dedicated to his funds as well as on themes on the market. Till then, thank you again, and please have a nice evening ahead.
Thank you so much, Nida, and good day to all our partners. Thank you. Bye.